Okay, good afternoon, everyone. Welcome to ACCA lecture. I'm James Wong, and today we're gonna continue our topic, which is Chapter 10, Procedures. So for procedures, we will talk further about the test of details and analytical procedures. So here's the topic for today. We will go through all the accounts and related assertions, and then we're gonna make sure that you guys understand how to design your audit procedures. And here we will have a receivables, inventories, liabilities, bank and cash, non-current assets, and all these accounts are very important to your financial statement. And then we will talk about the share capital, reserves, emoluments, right? And those are easier than and basically will not change every year, especially for the share capital and reserves. And for auditing estimates, we will talk about the inherent risk about the audit estimates, and then we would mention the small entities and not-for-profit organizations. So this is the schedule for today. Well, for the ACCA examinations, the audit procedures must be designed to respond to the specific risk of MM, right? And those risks of material misstatement, which we identified during the audit planning and test of controls, and then we're gonna design our audit procedures to respond to those risks, and we define the substantive procedures eventually. Right? So in the exam, you should make yourself specific to the scenario, right? It's not a general questions. It's based on the specific scenario. So you're gonna read through the text and learn the stories, and it is highly likely the scenario focus on the specific risk, such as the valuation of inventory, recoverability of receivables. So for those are a specific assertion of a certain account, right? And therefore audit procedures must focus on these features rather than general audit procedures. So you should mention the client's name and the manager's name and why they are doing this, and what is the procedures you're gonna respond specifically to that client, right? And remember that the auditor's role is to obtain sufficient appropriate evidence that the financial statements are prepared in all material respects with the relevant financial report framework, right? So for this reason, you will need to have a good understanding of the audit standards. So that is why, as an auditor, we should also be a professional at IFRS, right? So for audit procedures, we need to put that in a good layout and a good writing, right? So an audit procedure should be clear instruction of how the audit evidence is to be gathered. So you should include the actions, the resource, and objective, right? The three factors. In other words, it should describe what needs to be done and how it should be done and why it should be done. So here's an example. When as we are going to test the existence of an NCA, then we have a bad answer, which is check a sample of assets. This is very general, right? So remember, we should mention the action, source, and objective. So the right answer would be select a sample of assets from the ACCA register, right? So this would be your action, and the ACCA register would be your source, right? And specifically inspect, right? That's also an action. You're going to inspect them to verify existence. So verify existence would be your objective, right? So just remember that to include the three factors, which are action, source, and objective. And here's the so for good answer, you should mention from where the sample should be chosen, and how they should be checked, and the objective. So don't forget the three factors. Another example would be the test of evaluation of trade receivables. So a bad answer would be perform a receivable circularization for a sample of customers to confirm the balances are in existence at the year end. Right? But here we are testing for the valuation, right? Not the existence. So the good answer would be inspect post-year-end bank statements to identify if payments have been received post-year-end. If so, agree the amount to the receivables ledger at the year-end. Right. So that would be a good answer. So this is a tip for your examinations. So for those procedures, make sure you have all the three factors in your answer, and for the substantive procedures, there are key assertions for different kind of accounts. For transaction accounts, basically for your P&L accounts, you're gonna pay attention to the assertions of occurrence, completeness, accuracy, cutoff, and classification. For the balance sheet accounts, you should pay attention to the assertions of existence, right and obligations, completeness, valuation, and allocations. And then eventually you will have to present those financial statement and notes to your user, so that from presentation and disclosures assertion, you're gonna pay attention to the assertions of occurrence, rights and obligations, completeness, classification, understandability, accuracy, and valuation. Right? So for the source of evidence, that would be the documents. So you should have an idea on what kind of document you are looking for, right? What kind of document that your client has. Right? So there are several ways to design your audit procedures. First of all, you can identify the financial statement assertion to be tested. For example, you want to test the accuracy of a sales. Then as an auditor, you will need to agree the amount on the sales invoice and match the amount of records in the sales daily book. Right? So that would be the accuracy. So from accuracy perspective, you are gonna do lots of ties and reconciliations, right? And you're gonna match amount from A to amount from B, right? So that would be the assertion. And secondly, you're gonna identify the source of evidence available. So you're gonna talk to your clients and see what document they have. If we're gonna test the payroll, so evidence can come from pay slips issued to employees, and the auditor can agree amounts recorded on the pay slip to the amount recorded in the payroll payment list. So that will be your source. And as we are speaking of source, that means what kind of document you are looking for. You're going to inspect, right? And then we have to identify the types of procedures that we can use from RSA 500. For example, we can use the analytical procedures. For instance, if we are testing the receivables, auditors can calculate the receivables collection period. And then we can comparing the collection days with the prior year and see whether it takes longer than before to collect our receivables. And then if there's any unusual variations, we're going to investigate the difference. Right? We're going to inquiry the management. So that will be the key assertions. We will have this picture posted on every page today. So when you are answering the question of audit procedures, you're going to think of which one you are going to test and how you're going to test. Right? Don't miss any of the assertion. Right? And here's the directional testing. So as we are double entry bookkeeping, so when we are testing the accounts receivable, and actually we are testing the revenue at the same time. So that is why when we are testing the balance sheet items such as account receivables, inventories, payables, and we're still going to do the cut off, because although they are the balance sheet accounts, but they are highly related to a P&L accounts. So that is why for some of the balance sheet accounts, we're still going to do the cut off accuracy. So just pay attention to that. Okay. So that is the directional testing. So for every debit here, and we have a corresponding credit. So therefore, any misstatement of debit entry will trigger a misstatement of credit entry, right? So if you make a mistake of your revenue, that means your receivable is wrong, right? It's misstated, right? So auditors primarily test debit entries for overstatement and credit entries for understatement. Right? So indirectly testing. So we are actually indirectly testing the corresponding entries at the same time. So the directly testing for instance, if we're going to directly testing the payables for understatement, so that means we are indirectly testing a expense or a COGS for an understatement. Right? So we're going to test for understatement and we're going to test understatement by testing the assertion of completeness. And for overstatement, we're going to test the valuation, existence, rights and obligation, and occurrence. So to test for understatement, the auditor must select the sample from outside the accounting system and trace the transaction through to the accounting system. So that means if we're going to test a completeness of inventory, then we're going to choose a physical inventory to our accounting book. So if you're going to test the completeness, you should choose something not on your book, and then you're going to trace back to your book, see whether it is recorded in your book, right? So that's we call physical to book. So if you're going to trace from physical to book, that means you are testing the completeness. The opposite way, if you are tracing from book to physical, for example, you are selecting a sample from an accounting system, and then you trace it through to the supporting document, right, or to the physical inventory. That means you are confirming the occurrence, right, or the existence of your asset. So that is the difference. You will come across lots of questions on the completeness or existence. So don't make mistakes about from where to where, right? Physical to book or book to physical. So that would be very critical to answer your procedure related question. Okay, as to the specific accounts, first of all, we're going to talk about the bank and cash. Right? So the key assertions for bank and cash are existence and valuation, right? Because they're cash. Right? And where we can get those information or evidence? Those information are from a bank confirmation letter, bank reconciliations, cash book, or bank statement. So the bank and cash included in financial statement must exist and be included at the appropriate amount. The cash book figure is the balance which should be included in the financial statement, right? So the cash book figure is the balance which should be included in the financial statement. This may differ to the bank statement balance due to the timing difference, right? So that is why we need a bank reconciliations, right? And that reconciliation should be prepared by the accountants and then reviewed by a senior financial officer. So the bank confirmation letter is a third-party evidence, so which is very strong evidence. And that letter provides direct confirmation of bank balances from the bank. So it is the third-party, independent, written evidence, and therefore very, very reliable, right? So the client must give permission to the bank to release this information to the director. So because the bank has the duty to protect the confidentiality of their clients, which is also our client. So that is why when you are issuing a bank confirmation letter, you need a sign off from your client or client senior management, right? They're going to agree that you can obtain the information from the bank. So the confirmation request should be sent a minimum of 2 weeks before the client's year end. The letter should include enough information to allow the bank to trace the client, right? And the confirmation letter should be sent by the bank directly to the auditor office. So when you are issuing a bank confirmation letter, just make sure that you have the control of the overall procedures, of the whole procedures, right? So don't make your client have a hands on your confirmation letter. They should stay away from the letter, and all those information is between you and the bank. Right? It should be directly sent to your to you as the auditor's office. Right? So for the bank and cash, we have a lot of standardized audit procedures, right? And each of them are targeted at different assertions. So, for example, obtain the bank reconciliations and cash to ensure a arithmetical accuracy, right? So you are reconcile the things, and you are matching the numbers. That is how we test the accuracy assertion. And then we obtain a bank confirmation letter from the bank to confirm the existence and rights and obligations. right? So and then we agree the balance per the cash book on the reconciliation to the year-end cash book and financial statement to confirm the accuracy and valuations, right? And we agree the balance per the bank statement to an original year-end bank statement, and also to the bank confirmation letter to confirm accuracy and valuation. Right? So here, as you can see, we are reconcile the bank confirmation letter, the bank statement, the bank reconciliation, and your book. Right? 4 of them has to be reconciled, and if there's any differences especially on the bank reconciliations, it has to be reviewed and investigated. Right? So we trace all of the outstanding lodgements, right, to the prior year-end cash book, and post year-end bank statement, and the paying in book prior year-end to confirm accuracy and valuation and existence. Right? So that means for all those differences in your bank reconciliation, you have to for those for example a deposit in progress, right? All those differences have to be investigated, right? And then we trace those unpresented checks through to a pre-year-end cash book and post-year-end statement. And for any unusual amounts for significant delays, obtain explanations from management to confirm the accuracy, valuation, and completeness. And then we're going to examine any old unpresented checks to assess if they need to be write back into the purchase ledger, because in certain cases, the checks was issued to our vendors, but it's never been presented. So that means we need to review the very old unpresented checks. And we're going to inspect the bank confirmation letter for details of any security, which is the pledge or guarantee provided by the company, and any legal rights of set off, as this may require disclosure to confirm appropriate presentation, right? Especially the pledge and guarantees, right? Those items should be disclosed. And then we're going to review the cash book and bank statements for any unusual items or large transfers around the year end. As this could be evidence of window dressing. Window dressing is not it's not a misstatement, but from ACCA perspective, a window dressing means that you are asking your client to pay you earlier than they should be, or you are intentionally hold the payment to your vendor intentionally. So in that way, your cash, for example, gonna looks better than it should be, right? So that is window dressing. So when you find unusual items or large transfers around the year end, that means the management wants to cover something or wants the balance to look better than it should be. Right? So this verifies the completeness and existence. And then we're going to count the petty cash, right, in the casting at the year end and agree the total to the balance included in the financial statement to confirm accuracy and valuation and existence. Right? So those are the bank and cash. This is a sample of a bank confirmation letter. The critical thing, to my point of view, is the bank confirmation letter, right? Especially you have to stay control on the whole process. So here, the letter is sent from the CPA firm to the bank, and of course your client has to sign off, right? And this is the name of your client and their bank account numbers, and you may mention what kind of information you want. And this is the reality. This is the sample of the confirmation letter. Right? So you list the account numbers, balance on the books, and then you are asking the bank to confirm what is their record of the balance. So this is the bank and cash. It looks easy, but in reality, this is a very risky area, right? So just be cautious on the bank and cash, right? It can be very risky. And this is next is the NCL, non-current liability. So for non-current liability in F8, we are basically talking about the bank loan, which is a long-term bank loan. So for a bank loan, what we are looking for the document such as the loan agreement, your cash book, the bank statements, bank confirmation letter, right? Because in your bank confirmation letter, you're going to ask the bank lots of critical information, such as the bank balance, how much you owe the bank owe you, and how much you owe the bank, and is there any security, pledge, or guarantee between you and the bank, or covenants of your loan agreement. So for all those information, you can obtain from the bank confirmation letter. So this is very useful as third-party evidence. So the loan balances must be complete and valued appropriately in the financial statement. And allocation must be assessed as the client should show how much of the loan is due to be paid within 1 year and how much of the loan is due to be paid outside of 1 year. So for the loan less than 1 year, you're going to represent the balance on your current liability, and for the longer, for the balance due over 1 year, you're going to present the balance in your non-current liability, right? So the bank confirmation letter will provide the details of the loans and the amount, the interest rate, any security, right? All kinds of information about the loan, and that will be a third-party evidence. And the original loan agreement as well, which includes the very detailized provisions. So for the bank loans, we're going to obtain a breakdown of all loans outstanding at the year end and cast to verify arithmetical accuracy and agree the total to the financial statement. So that means we're checking the assertion of completeness, right? And then we're going to agree the balance outstanding to the bank confirmation letter. And by doing that, we are testing the accuracy, valuation, rights, and obligations, right? So bank confirmation letter can provide you lots of information. And then we're going to inspect the bank confirmations for any loans listed that have not been included in our financial statement. So that is completeness. And we're going to inspect the bank confirmation letter for details of any security or assets. right, and agree the details to the disclosure in the financial statement. So that will be the assertion of presentation. And we are going to inspect financial statement for disclosure of interest rates and the split of loan between current and non-current. So that will be the allocation, classification, and presentation. And then we're going to recalculate the split between current and non-current liability. So that will be the allocation, classification, and presentation. And then we have to inspect the loan agreement for restrictive covenants. So by covenants, that means if that covenant was breached, right? So the company will be required to repay the loan immediately. Right? So that covenant is very critical and very and will be triggered by certain agreement between your client and the bank, especially for the interest covering rate, for the profit, for the revenue growth, for the debt and asset ratios, right? Debt and equity ratios, which is the gearing. So by doing that, we are testing the allocation, classification, and presentations. And if a bank covenant has been breached, that means you're going to repay the bank immediately, and your long-term loan becomes a short-term liability, a current liability immediately. So you're going to reclassify that, right? And we have to inspect the cash book for loan repayments. That means in that way we can prove the existence, accuracy, and valuation. So for the related finance cost in the statement of profit or loss, we are going to recalculate the interest charge and any interest accrual in accordance. Right? So that will be the accuracy of finance cost and the completeness of accruals. And next, we will talk about the NCA, which is a non-current assets. For non-current assets, we are focusing on the existence, valuation, completeness, and rights and obligations. So the source of evidence we're looking for would be the NCA register. So if you have that PPE list, right, and your client should have such a register list, and then the purchase invoices, especially for the new purchased PPEs or other non-current assets, the new purchased within this year, the additions, and then sales invoices, capital disposal form. So there is new assets coming in, and old assets disposed during the year, right? So you're gonna examine or inspect the sales invoice and the disposal forms. The disposal forms should have authorizations and related information about the assets disposed. Other evidence would be the bank statement and cash book. Right, you're gonna pay for your capex, and then the physical assets. You're gonna count the asset, right? And then the ownership documents, including the title deeds and registration documents, and the depreciation policy and rates, and the capex budget and capital replacement plans. So for non-current assets, they must exist, completely recorded, and be valued appropriately, and must be owned and controlled by the entity. Right? So the auditor needs to obtain sufficient evidence over the existing assets, right? Additions, disposals, revaluations, depreciation and related disclosures, such as the PPE notes, depreciation policies, useful economic lives, and revaluations. So here's a typical note of the PPE. So at the beginning of the year, this is the existing assets, right? It's purchased in previous period. So that will be your beginning balance. And then for this year, you got additions which was newly purchased in this year. And then you got disposals, and then you have your ending balance. And for your ending balance, it was generated after the valuations and depreciation for this year, right? So that is the whole process of your PPE, or say your non-current assets. And to test in details of your non-current assets, we don't want to miss any of the basic data of your balance. So that is why we have to obtain the register and cast and agree the total to the financial statement. By doing this, we are verifying the completeness, classification, and presentations. And then we're gonna select a sample from the non-current asset register and physically inspect them to verify the existence, right? So don't forget, it's from book to physical. And then we're gonna from physical to book to verify the completeness. We're gonna select a sample of assets, and we're gonna inspect the asset register, right, to test the completeness. And then we're gonna inspect the assets for conditions and usage to identify the signs of impairment. Right? That will be the valuations. So when you are physical count the inventory or PPEs or any other non-current assets, you're gonna take a look at the conditions of those assets, right? That will be an evidence for the valuations, because they could be damaged, they could be obsolete, and they could be not used for a long time, right? And for revalue the assets, we're going to inspect the independent valuation report and agree the amount to the amount included in the general ledger and the financial statement. So that means we are verifying the valuation, and then we ensure that all assets in the same class have been revalued, right? So required by IFRS, if you're gonna revalue an asset, you're gonna revalue the whole class, right? So that's why we're gonna take that action. And then we're gonna obtain a list of additions, and for a sample, we agree the cost to supplier invoice. Right? So by looking into the original document, we can verify the valuation. And then we select a sample from the list of additions and review the description on the invoice to confirm that they relate to capital expenditure items rather than repairs and maintenance. Right? So that would be the criteria for the capitalization. Right? Some of those spendings should be capitalized, and some of the other spending should be expensed. And then we're gonna inspect a breakdown of repairs and maintenance. So we look into the repair and maintenance list to find is there any items should be capitalized. Right? And then we look at the capitalized list to find if there's anything should be expensed. Right? We look into the unusual items. And for sample of assets included in the non-current asset register, we're going to inspect the supplier invoices and title needs and registration documents. Right? And by doing that, we are investigating the rights and obligations. And for NCA disposed, we should obtain the breakdown of disposals, cast the list, and agree all assets have to be removed from the NCA register. So that means we are verifying the existence. So if you dispose an asset, and we're going to make sure that that asset will not on your register anymore. Right? And then we're going to select a sample of disposals and agree sales proceeds to supporting documentation, such as sundry sales invoice. And by doing that, we are verifying the accuracy of profit on disposal. And we will recalculate the profit or loss on disposal and agree to the statement of profit or loss. Right? And that is verifying the accuracy of profit on disposal. And for depreciations, we're gonna inspect the capex budget for the next few years to assess the appropriateness of the useful economic lives in light of plans to replace assets. Right. So if there are some of your PPEs still being depreciating in the year, but the management have a plan to replace all of them the next year, and that plan has been reflected in their next year's budget. So that means you should reconsider the valuation of the asset, right? And then we review profit and loss on disposal of assets disposed of in the year to assess the reasonableness of the depreciation policies, right? And the policy has to be reasonable, right? For machines, for the vehicles, for the computers. Do they have to be reasonable, right? And then we compare depreciation rate to companies with the same type of assets to assess reasonableness. Right? And then we recalculate the depreciation charge for a sample of assets to verify arithmetical accuracy. And then we recalculate the depreciation charge for revalued assets to ensure the charge is based on the new carrying value. Right? Because based on efforts, if the asset, the PPE has been revalued, then the depreciation next should be based on the new base, and the rest residual life. And then we're going to perform a proof in total calculations for the depreciation charged for each category of assets. And we discuss with management if significant fluctuation rates. Right? So that is the analytical procedures. So although depreciation is a very easy part of audit, but there are many management or taking their chance to manipulate the financial results by changing the depreciation policy, right? They're gonna extend or shorten the useful lives, and they're gonna manipulate the accounting policies of depreciations. Right. And then we're gonna inspect the financial statement disclosure of the depreciation charges and policies, changes and policies in drafted financial statement, and compare to the prior year to ensure consistency. And here's an example from the September and December exam last year. So here we got a scenario, and our client has land and buildings, and they historically recorded all PPEs at cost less accumulated depreciation. And now they're going to change the accounting policy to revaluation model. And then they hired a external independent valuer to undertake the valuations. And this happened in July 2006. Right? So then we were asked to describe substantive procedures and to make sure that we can obtain sufficient and appropriate evidence related to the PPE. So we're gonna obtain schedule of all land and buildings and cast agreeing to the TB and FS. So that means we are gonna have a list of PPE, and that list should be complete and ties to your TB and FS. And then we're going to consider the competence and capability of the valuer, right? Because the valuer was hired by your client. So we need to consider the competence and capability of the valuer, right? Then how we're going to do that? We're going to assessing through their qualifications, membership of professional bodies, right? And that means they should have the basic ACCA or the basic skills and profession required by that professional body. And then they should have experience in evaluating this type of assets. So that would be the projects that they were engaged in the past, right? So we're gonna ask for those information. And then we will review the assumptions and method adopted by the valuer in undertaking the revaluation to confirm the reasonableness and compliance with the principle of IAS 13. Right? So that doesn't mean we're going to accept the valuer's result of the valuation. We're going to do that by ourselves again. Right? We're going to review the assumption and method. So if it is necessary, we can hire a auditor's expert as well to evaluate that asset if the asset weighted a significant percentage in the total asset, right? If that is important. And then we agree the schedule of revalued land and buildings to the valuation statement provided by the valuer and to the NCA register, right? And we agree all lands and buildings on the NCA register to the valuation reports to ensure completeness, right? From physical to book, which is the valuation, which is the testing of existence, the completeness, right? And then we're gonna recalculate the total valuation adjustment and agree correctly recorded in the revaluation surplus, right? So based on that, first, if the revaluation is high, the revaluated amount is higher than the book value, then we're going to recognize the potential gain to OCI, right? Which is the revaluation surplus, right? So we're going to recalculate that, and then we are also going to recalculate the depreciation charge for the year, right? Because the depreciation, the revaluation occurred in the middle of the year, right? So we're going to calculate the depreciation into two phases. Phase 1 is before the valuation date, and phase 2 is after the valuation date based on the new base, right? And then for a sample of land and buildings from the NCA register, we're going to physically verify it to confirm existence, right? Here is a book to physical. That means we are testing the existence. Right? And for a sample of land and building trace back to the NCA register, and we are examining the completeness. And we will review the FS disclosures relating to land and buildings to ensure they comply with IAS 13. So that means we are testing the classification and understandability of the NCA. Right? So always remember what assertions you are looking for, right? And then you are gonna define your assertions, which is your target, and then where you are looking for it, right? It's a register, or it could be a valuation report. It could be the calculations of your client, right? And then you define your action. You're going to revalue it. You're going to review, agree, recalculate, obtain, right? So very simple. Your target, which is the assertion, and then your source of document, and then your action of the audit, right? And then there are some of the NCAs are tangible, but some of the NCAs are intangible. And for intangible assets, it's riskier, and it's a little bit difficult, right? Because some of the intangible assets were the self-developed cost. So in US GAAP, we don't have such development costs, and we don't have such such capex, right? But in IFRS, a self-developed intangible assets can be capitalized. So we're gonna pay a lot of attention to the threshold, to the criteria of the capitalization, right? Which is the sell and use, right? The commercial feasible, the technical feasible, the resources to complete, and the measure cost reliably, and the probable future economic benefit, right? For all those criteria, you're gonna be examined and tested and see whether certain items should be expensed, but they got mistakenly capitalized. Right? So we are gonna look into those documents and informations. There are breakdowns of expenditures during the year, right? And that is how your client gathering the cost, and they cap those capitalized expenses, capitalized items, and this is how they were doing that. They were doing it, right? So there should be a breakdown of that, right? And then a purchase invoices and bank statement, because they are paying for it, right? And timesheets, right? There should be a schedules, a plan, a Gantt chart, or about the project, the development project, right? And development expenditures and project plans, project test, trial results, right? So for trial results in project tests, that will be highly linked to the technically feasibility, right? And the cash flow forecast, right? That will be the resources to complete. Is there enough cash for the completion of that project? And the license agreement, third-party valuation report, and amortization policy and rates. So all those information and documents are right there to be inspected. So for intangible assets, don't forget IAS 38 and the criteria for self-developed intangible assets. So here's an example of September and December exam, and we were asked to describe substantive procedures and to obtain evidence in relates to the development expenditures, right? So we're gonna obtain a schedule of capitalized cost within the intangible assets and cast it and agree the closing balance to the general ledger, trial balance, and financial statement. So you're gonna tie everything and reconcile the total amount from different source, like your schedule, the balance on your financial statement, the general ledger, the trial balance, right? All those should be reconciled. And then we select a sample of capitalized cost and agree to invoices, payroll records, and other source. So for the capitalized cost, some of them are purchased from third party, so you got an invoice, right? Some of those has to be some of the research or project related management were carried out by your employees, so you have that payroll records. So all those documents should be agreed, and in order to confirm that the amount is correct and those amount goes to the right project. So that will be the valuation and allocation. And then we're going to discuss with the directors the decision to capitalize the cost from November the 1st onwards, and assess whether this is based on the project meeting all of conditions of capitalization in IAS 38. Right? For those capitalization criteria, we're gonna talk to the management and see what they can give us as evidence showing that those criteria are 100% met. And then we're going to review a breakdown of the nature of the cost capitalized to identify if any research costs have been incorrectly included. Right? So we're going to looking into the breakdowns and see whether there are items should be expensed, and that will be also the valuation. Right? And then we select a sample of costs recorded as research expense and development cost, and agreeing to supporting documentations. Right? And so we are looking into a list of capitalization, and we look for items that should be expensed. And then we look into the expenditures list and see is there anything that we should capitalize it, right? That would be the bigger picture. And then we review a market research reports to confirm that there is a market for the new process and that the selling price is high enough to generate a profit. Right? So if the market goes bad and the price is going down, that means the intangible asset should be impaired, right? It doesn't worse as as expected, right? And then we should review physical reports as at November the 1st and discuss with directors their view that the process was technically feasible at the date. Right? So if you can recall, feasibility is one of the criteria, right? So we're going to look for evidence of the feasibility. And then we review the budgets in relation to development project and the cash flow forecast in order to assess whether the client had access to adequate cash resources to complete the project, right? Another criteria of the capitalization. And then we discuss with the finance director the rationale for the useful life being applied and consider its reasonableness and agree to supporting documentations, right? The useful life. And then we recalculate the amortization charge and confirm that it covers the period from May to August, right? So that would be the recalculation of amortization. And then we review the disclosure for intangible assets in the draft of FS in order to confirm that they are in accordance with IAS 38. So that would be the representation of the NCA, right, of the intangible assets. And so that was an example. And then the standardized procedures includes obtaining a breakdown of capitalized cost and cast for mathematical accuracy and agree to the amount included in FS, right? And for sample of cost in the breakdown, agree to invoice and timesheets. And inspect the board minutes for any discussions relating to the intended sale or use of the assets. And discuss details of project with the project manager or management to evaluate compliance with IAS 38 criteria. Right? That would be a test of existence. And then we inspect the project plans and other documentation to evaluate compliance with IAS 38 criteria. Right? And then we inspect the budgets to confirm financial feasibility. We inspect the financial statement disclosure in the draft FS to ensure compliance with IAS 38. So as you can see, the standardized procedures are basically in our examples a minute ago, right? And then for other intangible assets, we're gonna inspect purchase documentations for the company name, and that will be our rights and obligation, right? And then the cost of the purchase the intangible asset, that will be the valuation. And then we inspect the specialist valuation report and agree to the amount included in the GL and the FS. That will be the valuation. So for intangible assets, there are different kinds of intangible assets, which are the brands, the goodwill, the patents, the trademarks, and knowledge, right? And for all these kinds of intangible assets, they have something in common, right? But they're different. So when you were asked about the question on brands, on patent, on trademarks, so you're gonna think about the specialization of those different kinds of the intangible assets. Right? And for amortization, we're gonna inspect the budget forecast for the next few years to assess to make sure that the economic benefits are expected to be generated and compared, right? And so we will also recalculate the amortization charge to verify arithmetical accuracy. Right? And for intangible such as license, we're going to inspect the license agreement to confirm the amortization period. And so these are intangible assets. And inventory, which is one of the most interested area. So the key assertions for inventory are existence, valuation, completeness, and rights and obligations. And we're going to look for evidence from aged inventory listing, inventory assets, inventory count sheets, purchase invoices, goods received notes, sales invoices, goods dispatched notes, which is the GDN, right? And client calculations of overhead allocation and absorption and apportionment and percentage of completion of for work in progress. So for an inventory, it has to exist and be completely recorded, be valued, and must be owned and controlled by the entity, right? So for inventory, we have two main factors. One is the quantity, right? So we should have the right quantity, and then is the pricing, which is the valuation of the individual inventory items. So that will be the inventory valuation or pricing. So ISA 4.1, which is audit evidence, saying that we should attend the physical inventory count if inventory is material to the financial statement. And we should perform procedures on the final inventory records to determine whether they accurately reflect the count results. And so why we are attending the inventory count? So because we want to evaluate managers' construction and procedures for the inventory count, right? So they should have the right control before and during the physical count. Right? Otherwise, the whole count is meaningless. Right? So they should have the right instructions and procedures. And then auditors observe the performance of the count. So we don't perform that. We don't basically touch the inventory. We just observe. We look and see how they count that, and we make sure they are doing it in the right way. And we inspect the inventory, and then we perform test counts. And the inventory count is the responsibility of the client. The auditor does not perform the count, so we are the one to observe the count. Okay. And so here's an example. This company had an inventory count instructions. Right? They have 13 instructions. And we were asked to describe our procedures before attending the inventory count. Right? As an auditor, what would you do before you attend the inventory count? And then what would you do when you are in the attendance of the inventory count? And then in your final audit, right, what is your substantive procedures to inventory? Here's what should we do before we joined a physical count. We contact the client to obtain a copy of inventory count and inventory count instructions to understand how the count will be conducted, right? And we assess the effectiveness. And then we review the working papers obtained from the previous auditor to understand the inventory count process and identify any issues that should be taken into account this year. So maybe last year there were some deficiencies or anything we should pay attention to. So this year we're going to improve that. And then we contact the client to obtain details of date, time, locations, and obtain a list of locations where inventory is stored and select which locations will be attended by the audit firm. If not all locations can be visited, right? So priority should be given to locations with high value or with poor controls, because with poor controls the risk is high, and we would like to look into that. And we consider the need for using an expert to assist in valuing the inventory being counted, right? For if you are maybe wines or expensive inventories that as an auditor, we don't really understand how expensive that works, but maybe we need an evaluator, and we need an expert. And we ascertain whether any inventory is held by third party, right? If it's held by third party, that is risk. And if we hold any inventory from third party, that is also another risk. And we request a direct confirmation of inventory balance held at the year end from any third party warehouse provides regarding the quantities and conditions. Okay? So that would be the job we should do before we attend a physical count. And then during the count, we should test the controls, and we should have substantive procedures. We should observe the count to ensure the inventory count instructions are being followed, right? So they have, first of all, they have an instruction, and it looks efficient, but we're gonna observe whether they are following it. And we inspect the count sheet to ensure that they have completed in pen rather than pencil, because pencil is easy to be changed, right? And then we inspect the count sheets to ensure they show the description of the goods but do not show the quantities. If the quantities were also printed from your system, that means people are has a target of the quantity, and they may just take on that. Right? And then for reperform, we will reperform the consequence tag, because we don't want any of the count sheets to be missing. And we inquire of the accounting staff which department they work to ensure they are not warehouse staff, because warehouse staff, they play the tricks, right? So we're gonna let staff from different functions to take the count. And then for substantive procedures, we select a sample of items from inventory count sheets and physically inspect the items in the warehouse. Right? And then we select a sample from the warehouse and trace to our books. Right? So from physical to book, book to physical. And then we inquire of management whether the goods held on behalf of third parties are segregated and recorded separately. Right? So be very careful on your inventory held by third party and third party's inventory held by you. That could be a high risk. And we inspect the inventory being counted for evidence of damage or obsolescence. Right? And that is for test of the valuations. And then we record details of the last deliveries prior to the year end, and this information will be used in final audit to ensure that no further amendment have been made. So we just take the last record. Okay? And then we obtain copies of the inventory count sheets at the end of inventory count, and we check the final listing. Make sure there's not a single counting sheet missed. And then we attend the inventory count at the third-party warehouse, verifying the completeness and existence. And so before attending, there are a few actions auditors should take, and then attending the year end. The physical count around the year end, and then maybe in March or April, it's the time for auditors to carry out the on-site audit, which is the final audit. And during the final audit, there are also procedures for inventories. We trace the items counted during the inventory count to the final inventory list to ensure it's the same as the one used at year end, and to ensure that any errors identified during the counting procedures have been rectified. Right? And we cast the list to ensure arithmetical accuracy and agree total to financial statement disclosures. We trace goods received immediately prior to the year end to year-end payables and inventory balance. We trace goods dispatched immediately prior to year-end to general ledger. We inspect the purchase invoices for the name of the client. We inspect the purchase invoices for sample of inventory items to agree the cost, which is the valuation, right? And we inspect the post-year-end sales invoices for sample of inventory items to determine if the NRV is reasonable. Because if the sales price are highly dropped, that means NRV that means the inventory is held at a lower of the cost than the NRV, right? So that means the NRV is lower than the book value. So we recalculate the work in progress and finished goods, and we're gonna using payroll records for labor cost and utility bills for the overhead assumption. So that would be the costing. We review the costing process and verifies the valuations, and we inspect the aging of inventory items to identify the old, slow-moving items, and then and we may require an allowance. So that will be the verification of valuation. And then we calculate the inventory holding period and compare this to prior year to identify slow-moving inventory, which requires an allowance to bring the value down to the lower of cost of an NRV. Right? So with slow-moving inventory, that means there could be damage or there is no market for the inventory. So from that analytical procedures, we might identify an allowance. And we calculate gross profit margin, and we compare this to prior year. With that analytical procedures, we can investigate any significant differences, and that may highlight a narrow in cost of sales and closing inventory. Right? Because if there is not a good reason for the fluctuation of gross profit, that means something goes wrong with the COGS or inventory. Right? And if COGS goes wrong, that means your inventory goes wrong the other way. Right? So every company has an inventory system. So with that inventory system, the company can keep a real-time track of inventory records. Right? So the inventory level stays in the perpetual inventory system. It may gradually diverge from actual inventory levels, because day after day, if there are accumulated unrecorded transactions or inventory safe, so your actual inventory balance might be far away from your balance on the book. So that is why we need to count the inventory periodically, and we're gonna correct any error, and we're gonna investigate unrecorded transactions, and then we'll make sure that our real-time inventory system is up to date. Right? It can reflect your real inventory level. So your client might count periodically, say monthly cycle counting. Right? So they're gonna count like 10% inventory in January and the next 10% inventory in February, right? So with that cycle counting, they can they can make sure that at least an inventory can be counted once during the year, right? So as auditor, we should attend at least one count to ensure the internal control is adequate, right? And then we inspect the number and value of adjustments made as a result of the count. If significant adjustments are required after each count, so that we should pay attention to that, right? Because each count there is a significant adjustment, so there must be something goes wrong, right? That and makes the system has to be corrected in each time. And that means maybe the internal control cannot be relied upon at the year end. If the system balance for inventory is deemed reliable as a result of these procedures, further procedures to verify valuation and rise will still be required, right? So we cannot just rely on the internal control. We're still going to take the substantive procedures. And the auditor will still need to perform the audit procedures at the final audit, such as inspect the GRNs, GDNs around the year end to confirm the cutoff, right? We review the purchase invoice and post-year and sales invoice to ascertain if NRV is still above the cost, right? And then we compare the inventory holding period with prior year to identify slow-moving inventory which needs to be write down to the lower cost and NRV. Right? And we inspect purchase invoices for the name of the client to confirm rights and obligation. So with the inventory system, the advantages would be it can reduce time constraints. It's the slow-moving and damaged inventory can be identified, right? Because you have a system and it's a real-time track. But the disadvantages would be the system operates efficiently, maybe at the time of the count, but we cannot sure that it's functional during the whole year, right? At all times. And additional procedures should be necessary to ensure that the amount is appropriate, particularly with regard to the cutoff and year-end allowance. So inventory held by third party, as we mentioned, this could be a risk, right? So some companies will not have space to store all their inventory, and they may ask for a storage facility to a third party. So the inventory held at a third party may still be counted, and auditors should obtain sufficient appropriate audit evidence that the inventory actually exists and belongs to the client. Right? And our procedure would be where a third party holds inventory on behalf of our clients, so we can obtain an external confirmation from the third party, right? A confirmation letter. And if the inventory right there is material, then we're gonna have to attend the inventory count to verify the existence of the inventory. And we're gonna also obtain a report from the third party's director confirming the reliability of the internal controls at the third party, right? So that means the warehouse, the outsourced warehouse auditor, it will be their auditor, which is service auditor. Right? And third party inventory stored at the client. So that means in our warehouse, there are some inventory that doesn't belong to us. Right? This is also a risk. So if client stores inventory on behalf of third party, they should have procedures in place to ensure this inventory is not included in their own records, right? So they should be separately identifiable, and they should be separately located, right? And so during the inventory count, we should pay a lot of attention on that at different location, right? And that will minimize the risk of being counted as part of the client's inventory, right? But actually, we should also take a look at those kind of inventory, and maybe those inventory belongs to your client, right? But so we should keep the skepticism, right? So we take a look at that. And for the standard costs, a lot of manufacturing companies, they use standard cost because standard cost is easy and it can be a real-time monitoring of the cost. So by using the standard cost, that means there will be a variance between the actual cost and standard cost. And that variance goes to PPV on your balance sheet and over under in your P&L. So if that variance goes really big, that means your standard cost is definitely wrong. It's not even close to your actual cost. So that is why the standard cost should be reviewed and updated regularly, right, on a regular basis. So as an auditor, that process is not our responsibility. Then our responsibility is take the evidence, right? So we're gonna assess the reasonableness of the standard cost that our client is using. So obtain the breakdown of the standard cost calculation and agree a sample of cost to invoices. And we inquire of management the base for the standard cost and how often they are going to update. And we inspect the variance accounts and assess the level of variance for reasonableness and discuss with management on any significant variance arising. So for inventory count, there is a cut-off procedures. So the overall target is make sure that there's no inventory moving during our count, right? If everything is moving around, then our physical count doesn't make sense anymore, right? So the inventory count will be effective by goods dispatched and goods received. And so during the count, inventory movement should preferably stop, right? They should stop. But if they cannot stop, then you might create a deferral or a buffer area, right? So make sure your client can have like 6 hours material, and so during the 6 hours, there's nothing move around, because here, if they have to dispatch the material to the production line, they can use the material in a special area, right? But other areas, all inventory stopped, right? So that would be a specific design when you are in a certain customer's warehouse, right? And so in this type of organizations, the client should move the items requiring dispatch to a different location and being counted prior to the count. So that is what we call a buffering stock location, and make sure that those material or goods to be shipped are gonna hold at least 6 hours, or at least after you finish your counts, right? But during the count, except for the that location, all the inventory should stocked, right? No movement. And for the item delivered during the count, and we're gonna count them first, right? Before they can ship anything, and then they would consume the materials which we have count in the next 6 hours. Right? So by having such control in place, the completeness and the existence of the inventory at the count date can be verified, as well as the cutoff assertions for purchase and sales. So just make sure no movement during the count, right? And here's an example. We got a client. They were in the hotel business, and their inventory are food and beverage, right? So we were asked to design our audit procedures before and whilst attending the inventory count, and assertions relevant to inventory, and our substantive procedures that we're going to carry out to confirm the valuation, right? So before the count, we inspect prior year's working paper. We count clients to having their instruction and procedures, right? We ascertain whether there's any inventory is held by third party. We consider to use an expert, because the beverage can be, some of the wines can be very expensive, right? But we need an expert to smell on it or to look at that. And during the count, we're going to observe the count. We inspect the bottles which might be damaged or obsolete sized, and we select a sample from book to physical to physic, and from physic to book, right? And then we cut off information by obtaining details of last deliveries prior to the year end. And for the assertions, so these are existence, rights and obligations, completeness, accuracy, valuation, and allocations, and cut off and presentations. And for substantive procedures, we might trace the items counted during the inventory count to our final inventory list. All right, the quantity should be the same. And we inspect purchase invoices for a sample of beverage to agree cost, which is the valuations. And for beverage to customer about the year end, we inspect a sample of restaurant bill back to the final inventory records, ensuring that sales value exceeds the cost. So that would be the NRV and the valuation, right? So for high value items, we're going to use the expert valuer. And inventory noted during the count was obsolete or damaged should be traced to the inventory records to ensure the valuation has been adjusted. Right? So in our examination, my advice is that you should create your own list of answers. For example, for bank and cash, NCL, NCA, inventory, you should have a list of your procedures, and during the examination you can easily use your defined procedures, right? And which is your checking list. So here's another example, which is from the March and June examinations. So this is a manufacturer of food for dogs and cats, and we were required, and they are the one using standard cost. We were required to describe substantive procedures and regarding the valuation. Right? So we obtain and cast the inventory listing and agree the total cost, and we agree the quantity to inventory count records. and we request breakdown of cost calculations and discuss with management how the standard costs were derived. Hopefully, they should have a manual or a some kind of guidance, right? And recalculate the cost calculations to confirm that the quantity multiplied by the standard cost is 2.4 million. Right? We're going to reperform that. And then for sample of finished goods, obtain standard cost card and agree the raw material, the labor cost, the overhead, because as a standard cost, those items should be very straightforward, right? Just get that standard cost and verify the value. Right? So we compare sales price over time to establish if the price has been reduced. So that will be we're going to look into the NRV, and which is also the assertion of valuation. And we compare the actual sales units per month to budgeted sales per month, and from and after the year end to establish how much lower actual sales than expected. Right. So maybe some of those inventory is obsolete because the market demand is going down, right? And we elect a sample of items included in the inventory, and we review the past year-end sales invoices to ascertain if NRV is above cost. All right, and that will be the inventories, and we are now going to talk about the AR, the receivables. So for receivables, our evidence are the aged receivables listing, our sales invoice, our GDN, our circularization letter, which is the confirmation letter, right? And post-year and bank statement, and policy for allowance for doubtful receivables. So the receivables should exist with the right amount, and it is highly possible that the receivables might be overstated because they need to because maybe irrecoverable receivables have not been written off, or doubtful receivables have not been written down. Right? So third-party evidence would be the circularization letter, which is the confirmation letter. So we're going to send the circularization letter to client, and that would prove the existence but not the valuation, because the customer may not paying for it. So you are sending a confirmation letter to your customer and they are replying it. Doesn't mean they're going to pay for it, right? So we have two kinds of circularization letter. One is the positive, the other one is negative. So if we are sending a positive receivable circularization letter, that means we need a response to our letter, and the customer will say on our books the balance is different or the same, and maybe there's other transactions going on, right? It's an open question, so we leave everything blank, and customer can reply and sign off, right? But for negative receivable circularization letter, it's assumed that the customer doesn't have to reply to this letter as long as they agree on the numbers or on the items in the letter. So maybe they never received it, or maybe they don't bother replying the letter. It doesn't mean the information is correct, right? So basically, no one uses a negative confirmation letter, although it's one of the options, but no one is going to use it. So steps in undertaking a positive receivables circularization would be, first of all, we're going to obtain a concession from our client. So they are the one we should get the concession from our client. So they should be okay that we're gonna send a confirmation letter to your client, to your customers, right? And we obtain a list of AR at the year end, and we cast it and agree to our GL. And we select the sample from the receivable list. So what kind of sample we are interested? We're interested at large balance, right? Credit balance, old balance, zero balance, or a small balance but with very big transaction during the year, right? Those are the balances we are very interested. And circularization letters should be prepared on the client's letterhead paper requesting a confirmation from the year-end receivable balance, right? And appropriate member of the client staff, basically the CFO or finance director, they're going to sign off on the letters. And if there's no response from the customer, we're going to follow up, and we're going to call the customer. And but if we tried our best, still no response, then we might consider using the alternative procedures, say the after year cash collection, right? As well as the invoice, GDNs, make sure the transaction is real, it's real happening. And when replies are received, and then we should reconcile to clients' receivable records, because sometimes customer may come back with a different number, so we're gonna have to investigate further on the difference. Right? So ISA 505 is the external confirmation. It requires the auditors to maintain control over the whole process. So we are going to prepare the confirmation letters and determine the information to be requested. And we will select the sample of external parties, and we will send the request to confirming party. So this is a sample of our AR confirmation letter. So we'll take a 10 minutes break, and we will be back very soon. So next, let's take a look at the receivable example. So here we got a aged receivable analyzed from our client. So if you were the auditor, what sample you're gonna take, right? So here, let's look at number one. It's a Joe case. So why we are choosing Joe case, right? It's because Joe case had a very big balance, which weighted over 20% of the total receivable balance. Right? That's why we are choosing Joe case. And next, where we choose a golf is us. Why we chose him? Why we chose it? Because they have a very long-term overdue receivable balance. Right? So we want to look into the overdue balance and see what is going on, and if there's any, is it necessary to accrue bad debt? Right? And then tick. It is very strange that they have a credit balance of receivable, right? So we're gonna take that sample and send and make a further testing. The very last customer we would like to test is Wellster, and this customer has a very big credit balance and very big debit balance at the same time. So there must be something wrong with the although the overall balance is very small, but it seems there are the large payment and an outstanding balance at the same time. Right? There could be potential errors. So this is how we take samples from the AR aging list. And for accounts receivables, the standard process would be we obtain the aged receivable listing, cast it, and agree the total to financial statement. Right? We agree the receivable ledger and control account, and with the receivable ledger list of balances. And we select a sample of year-end receivable balance and agree back to a valid supporting document of GDN and sales order. Right? And we inspect after-date cash receipts and follow through to pre-year-end receivable balance. And most of the time, this procedure would be used as an alternative procedure because in case we cannot get a confirmation letter from the customer, then we may look into the post-year collection, the post-year cash receipts, to see whether we were actually being paid. And then we perform a positive receivable circularization. Right? We send a positive confirmation letter. Right? We inspect the aged receivable reports, and then we identify any slow-moving balance, and see whether we should accrue any allowance or write down. And we discuss any significant balance with management to identify any issues regarding payments. We inspect customer correspondence in respect of any slow-moving aged balance. Right? We inspect the board minutes to assess whether there is any material dispute, right, that may require a write-off. And we inspect the receivables ledger for any credit balance. And we will see if we should reclassify as payables. And then we inspect the sample of post-year-end credit note to identify any that related to pre-year-end transactions, to ensure that they have not been included in receivable. Right? Because it is possible that there are large sales right before the year end, but at the very beginning of the next year, there are lots of credit notes generated from the goods return. So in that way, we should not record those receivables and revenues, right? Because they were returned. So we calculate the average receivables collection period and compare this to prior year. So that is a analytical procedure, right? Okay. So another example, we were required to describe the steps that we're gonna do for a confirmation test. And we're going to explain why a direct confirmation test may not provide sufficient appropriate audit evidence on its own. Right? So we are the auditor, and this year our client accrued a general allowance, which is 2,490. So, but in the past year, the general allowance percentage would be 3%. And this year, customer changed the percentage from 3% to 2%, which is very aggressive, right? And then in the past year, we got two specific allowance, belongs to two specific customers. Right? But this year, there's no specific allowance. At the same time, there are two major customers went into liquidation. So then you should have an impression that there should be some specific allowance accrued, right? Because you got two major customers in the liquidation process, right? And we were required to describe our substantive procedures and how audit software would facilitate the process, right? Which is interesting. So for the circularization, which is the confirmation letter, we obtain client approval, right? As we mentioned before, these are the standard confirmation letter procedure, right? Obtain approval from client, obtain the list of AR customer, we select a sample, we prepare the confirmation letter in contact details, return details, and then we want the customers who received the confirmation letter to reply directly to us, right? And we ask the client to print the letters with their headlines, with their client-headed paper and sign off, right? But we are the one to mail it to customer, right? And then the auditor should send the letters, including any follow-up requests, and reconcile replies. If there's any difference, we're gonna investigate that. And we perform alternative audit procedures if we tried everything, but still we don't get a reply. So we should do the alternative procedure. And for the sufficiency of the evidence from a direct confirmation test, it's based on the quality of the process, right? For example, if you have a low response risk, that means your confirmation letters cannot cover most of the balance, right? So the quality of the evidence is low, right? Or the type of confirmation letter is a negative confirmation request. If you are sending a negative confirmation letter, that means the quality is pretty low. Or the reliability of the response to the confirmation request may be in doubt, right? For example, if there is a risk of fraud being perpetrated, or mistakes and errors, or customer may agree with balance containing errors in their favor. Maybe that's receivable if your number is small, customer just confirm a small number, right? So that is why a direct confirmation test cannot be the only evidence you take from receivable, right? It is an important third-party evidence, but it should not be the only one, right? Because it does have the shortages. And so our substantive procedures for AR would be: we can obtain the receivable listing, verify the arithmetical accuracy, we confirm the AR control account to GL, from sample of GDN year to year and trace to invoice and ledger accounts. We select a sample of individual trade as receivable and perform a direct confirmation test. We inspect the cash book and for the post-year cash receipts. And then we recalculate the general allowance based on the 2%. And we discuss with the management why you turned that percentage from 3 to 4 to 2, right? And the reason should make sense. Otherwise, they are manipulating the financial result. And inspect the aged receivables analyzed to identify aged debts and see whether there should be a specific allowance. And confirm that the specific allowance made in prior year has been written off or recovered. Anyway, be resolved, right? And as we speaking of the audit software, it can be used to prepare an aged receivable analyze It can help identify credit balance and negative balance. It will be more efficient and accurate when we are reconciling different balances. And it could also select the sample automatically and prepare letters and print it very automatically. Right? So for the trade receivables secularization, we have two response from customer. Number one is company nil. There's no response. Number two is company Congo. There is a difference between the response and our book value. So how are we gonna design our audit procedures? For nil, we are gonna send a follow-up confirmation. We're gonna telephone call them. But if we tried everything, still no response, we're going to take alternative procedure, right? And for Congo, we're going to investigate the difference, and especially if the difference is caused by the timing difference due to timing, say the customer has paid us right before the end of the year, but we haven't received it because of the checks on the way or the transactions pending in the bank, right? That makes sense. That's okay. If the difference relates to goods in transit, then details should be agreed to a prior year DDN, right? And maybe the difference is caused by the misposting. That would be a misstatement, which is what we are looking for, right? So another example is from the March and June exam. So this scenario is like there is a major customer, right? And but the major customer is suffering a operating issue. Right? Many of the stores has closed, so that implies there might be a bad debt, or you should accrue allowance of your receivables, right? So our procedures would be we review the correspondence between our client and their customer, and see is there any discussion going on between them, and what is the settlement here, or we review the age of the outstanding debt and see if the credit term has been breached. So there must be something wrong with the client, right? They are closing down the stores. They are not in a good shape, although they are saying that they're going to pay you, but it's overdue. Overdue is an overdue, right? So what are you gonna, if it's not going to be recovered, you should accrue the allowance, right? So, and then we're going to inspect the board minutes and to identify whether there are any significant concerns related to this customer, right? And we discuss with management why there's no allowance being accrued, right? And we will see whether the explanation makes sense. So, prepayment. Prepayment is a different kind of receivable, right? Because customer is paying you now, and you are gonna delivering the goods later, so they are paying in advance to you. So for this kind of balance, it's a credit balance, right? So we inspect the bank statement to ensure payment has been made before the year end, right? And then we inspect invoices to ensure payment related to goods or service has not been received, has not been delivered, right? And recalculate the amount prepaid to confirm the mathematical accuracy, right? And compare prepayments with prior year, right? So the other way we might have a prepayment from customer, and we might have a prepayment to a supplier, right? For those different kind of those prepayment, we're gonna make sure it's an asset balance or it's a liability balance, right? And it's a long term or a short term. If it's longer than 1 year, then it should be a non-current. Right? And next, we're going to talk about the payables and accruals. So for payables, we are paying more attention on the completeness because people are willing to understate the payables, understate the expense and cost. Right? So where we're going to look for that? We're going to look for the evidence from the aged payable listing, from the purchase invoices, from GRN, post-year-end bank statements, supplier statements, supplier circularizations, right? And the payments balance, including the financial statements, must be accurate and must be complete and understated, because payable will be understated if it's not completed, right? And third-party evidence is important from supplier statement, which could be a monthly statement or a supplier circularization letter. And the standard procedures for payables would be: we can obtain a list of AP and cast to verify the arithmetical accuracy, and agree to the general ledger and the FS, right? And we reconcile the total of individual payable accounts with control accounts. We obtain supplier's statement and reconcile this to the payable balance, right? And we inspect after-date payments. If they related to current year, then follow through to the payable ledgers or accruals listing, right? So we inspect invoices received after the year end, in respect of goods delivered before the year end, and trace through to accrual listing. And we require of management their process for identifying goods received but not invoiced, and ensure that it is reasonable. Right? We select a sample of goods GRN immediately before the year end and follow through to inclusion in the year end payable balance. Right? So those are the standard procedures to for account receivable. In addition, we select a sample of payable balance and perform a trade payables circularization. We send the confirmation letter to suppliers, and we inspect the trade payable ledger for any debit balance, right? Then maybe we should reclassify them to the asset balance, to the asset on the financial statement, right? And we compare the list of payables and accruals against prior year and see if whether there is a big increase and whether it can be explained reasonably. And we calculate the trade receivable payment period and compare to prior year, and we investigate any significant differences. Right? So those are for trade payables. And for accruals, accruals means we have received the goods or we have consumed the service. However, we haven't paid the supplier, and we haven't received the invoices. So, but the goods and service has happened in this year. So we're gonna accrue it as a liability, right? So the procedures for those accruals would be that we obtain the list of accruals from the clients, right? and then we cast it to confirm mathematical accuracy and agree to the general ledger and the financial statement. Right? And we tie the numbers and we reconcile it between different balance. And then we recalculate a sample of accrued costs by reference to contracts and payment schedules. Right? We're going to recalculate, for example, the interest of loan, and we also inspect invoices received post year end to confirm the total amount and assess whether the accrual is reasonable, right? Because invoice comes after the year end, but we can still look into that invoice and see whether our accruals before the year end make sense, right? And then we compare the accruals this year to last year to identify any missing items or unusual fluctuations in the amount and discuss this with management. So the comparison is a kind of analytical procedure, right? We compare the accruals. So basically, there should be an routine accruals, but if there's any special accruals, we're going to look into that, right? So here's an example. We got this is the account payables on our book, right? But in the meanwhile, we have the supplier's statement, and these two looks very differently. So we're gonna prepare a reconciliation, and we will see whether the data in here why it's not on the supplier's statement, and whether the balance on the supplier's statement is not on our book. So that would be the purpose of the reconciliations. And for the differences, for the variance, we have to take action. We have to follow audit procedures to look into that. And we were asked to describe the audit work you will carry out on each of the reconciliation items. Okay? Okay. So there are two reasons for the difference. Number one, which is normal, that will be the timing difference, right? Because suppliers might pay us right before the year end, but we haven't received it. Right? But the timing difference should make sense, right? It cannot be like two months ahead. It should be a couple of days difference, right? And the other reason would be the errors, which is the misstatement we were looking for, right? So the reconciliation of our book, this is our balance per payable ledger, and then we've seen all the different between the two statement, and this is the balance per supplier's statement. So difference number one is the discount. So obviously we have booked the discount, right? But the supplier doesn't, because the 61,000 until after the 30th November, and that is why the supplier doesn't count the 2% discount, because it's more than it's already after the month, the end of the month, right? So supplier doesn't count any discount. So that would be the difference number one, right? We paid right before the end of November, but supplier received it on the 10th of December. So the supplier will not give us the discount. So that means we are the one make mistake, right? And number 2, transposition error. So here is the invoice number 6000. Right, this one. So our book is 35,000, but supplier's book is 37,000. So there must be something wrong, right? So we're gonna look into the invoice to inspect the original invoice and see what is the right amount. And difference number 3 is invoice number 6201 is not on payable ledger. So we're gonna take audit procedures, right? (6210). It's on supplier's statement, but we don't have that, right? And the other one is 6355, right? Supplier has that payables, but we don't have it. So our audit procedures would be, we're gonna inquire and warehouse manager and see whether we have shipped the goods, and GRN review the discussions. If the goods has been received, then the invoices we're gonna inspect to identify if there is a related purchase invoice. If there is a purchase invoice, an auditor should inquire with the purchase department why the invoice has not been posted, because it's on the supplier's book, but it's not on our book, right? We have received the goods, we have the invoice, but why we didn't book it? Did you do that intentionally to lower your cost, lower your liability, which will makes your financial statement better, right? So this may be because of a dispute as well. So if the goods relating to this invoice are in inventory, a purchase accrual should be made for this item, right? So if right before the end of the year we have confirmed that goods received, so we should make the accrual, although we haven't received the invoice yet at the end of the year, right? We should make the accrual. And if the goods have not been received, no adjustment needs to be made, because it seems we are the right one. We are doing it right. We haven't received the goods, we haven't received the invoice, so nothing should be reflected on our book. So we are correct. So that is our logic, but and we're gonna inspect those documents. And the other invoices is also not on payable ledger, and this one seems pretty close to the end of the year, right? 28th in December. So our procedure would be, we're gonna inspect the GRN, and if the date is before year end, then we should accrue, right? Although invoice comes later, the very first day the next year. Right? So the checks on the end of the year appears to be cash in transit, right? There is a check, and this one seems to be cash in transit, right? But the problem is that because this one comes with a discount, so we send the check in the very last day of this year, but the supplier received it. Of course, they're gonna receive it the next year, so there will not be any discount, right? And this is the way how we reconcile the supplier's payment, and how we're gonna investigate each of the difference. And next, we're gonna talk about provisions and contingencies. So based on efforts, and if we're gonna recognize a provision, then we have to it has to be probable. Probable means it's higher. The probability is higher than it's more than 50%, right? And that was a provision. And for contingent asset, the possibility is less than 50%, right? So that's the difference between a provision and contingencies, right? And those are liabilities. And for contingent assets, it has to be over 90% probability. Then we can recognize a contingent asset. So that would be, you can feel the difference, right? As an accountant, we take the very cautious way to measure asset and liability, right? And for the contingent asset, between 50 to 95% possibility, we're still gonna disclose that. But below 50%, we don't even mention it, right? So just be very careful on the possibility, right? Virtually certain, probable, possible, right? Make sure you understand the underlying percentage of probability. And for provision and contingent liability, we care about the obligation exists and whether it's probable or possible. Because if it's a probable, then we should recognize the provision, right? But if it's only possible, then we can just disclose it, right? It's a contingent. So that's the difference between provision and contingent, right? And also it should be valued appropriately. And completeness is also the key assertion, because most of the company, they don't have a fair charge on the possibility, and they don't recognize any contingent liability because it looks bad, right? So for contingent assets, it's very cautious. We only recognize the virtually certain assets, right? So we care about the probability, which should be 95% high, and the existence is the key assertions, right? And example of contingent assets would be an insurance claim, right? The insurance company is going to pay you the compensations, or a legal claim, or a receivable from a liquidator. So our procedures for provisions and contingent liability would be that we obtain a breakdown of the provisions, we cast it and agree the figure to FS, we inquire with the directors or inspect the relevant supporting documentation to confirm that a represent obligation exists, right, at the year end. And we inspect relevant board minutes to ascertain whether payment is probable, right? And we recalculate the liability and agree components of the calculation to support documentations, right? We inspect post-year end bank statement to identify whether any payments have been made. Compare actual payments to the amount provided to assess whether the provision is reasonable, right? So we accrue that provision and the contingent liability, but after the end of the year, there is someday we actually paying for the provision or liability. So we can prove that our accruals is correct or not, and we inspect the FS disclosure of the provision and contingent liability. Right? We should disclose the contingent liability, and we're gonna also the provisions, and provisions have an amount on financial statement. And we obtain a written representation from management that they believe the provisions and contingent liability are treated appropriately in the FS, right? The management's written representation. And also for warranty, this is a provision, right? And we should have a fair estimation on the warranty. So our procedure will be, we obtain a breakdown of the warranty provision, and we're going to recalculate the arithmetical accuracy. Right? And then we inquire the management, what is your base used for the provision? Why the returning rate or the maintenance, the repairing rate is about 3% of your overall sales, right? Why is that? So we assess whether the explanation from the management is reasonable, and we compare the previous year actual warranty cost with the amount provided for to assess whether management process is reasonable, right? Because the warranty is an ongoing process, so there should be a pattern that a certain percentage can be calculated, or a certain ratio can be reflected in the historical trend. And then we compare the warranty claims post year end to the warranty provision at the year end to assess whether the provision is adequate. Right? We had an accrual of the warranty by the end of December, but in January, February, and March, the warranty comes. So we should have an actual number, and then we can compare the actual return, the actual warranty, with our accruals at the year end. And then we review the product returns and compliance to assess whether there is a need for higher provision than previous years. If there is a new model of product, or if the market is being critical on the product, and or there's any negative news, in this way, we might have a reason to believe that the provision, the warranty rate should be higher, right? In the calculation, we calculate warranty cost divided by revenue, which is the percentage of the warranty, and we compare it with prior year to assess whether the level of provision is consistent with the prior year. So that would be an analytical procedures, right? So, and then we can discuss the change, the unusual percentage with management. Right? And lawsuit can be the legal provision, right? So the lawsuit, we're gonna inquire with directors when the employee was dismissed, to confirm that a present obligation exists at the year end, right? And we inspect correspondence between the employee and the company to verify that the employee was dismissed before the year end. And we inspect relevant board minutes to ascertain whether it is probable that the payment will be made to employee. We obtain confirmation from the company's lawyer about the likely outcome, which is a probability of the payment, right? It depends. It will define. It could be a provision, could be a contingent asset, a contingent liability, or we don't really care about that, right? Because of the probability. And we inspect correspondence received from the lawyer regarding the legal provision to assess whether a provision should be recognized, or if so, whether the amount of the provision is adequate. So the lawyer is very important to because he's going to use the professional judgment and maybe give us a few possible outcomes and the related possibility. And we're going to obtain a breakdown of costs to be provided and recalculate to ensure completeness. and agree the components of calculation to support documentation. Right? So, for example, the fee estimate from the lawyer and claim received from the ex-employee. And we inspect the post-year-end bank statement to identify whether any payment has been settled. Right? So that would be for the lawsuit. And we can also obtain a written representation from the management to confirm that adequacy and reasonableness of the provisions, and of course inspect whether it has been disclosed correctly in the financial statement. Right? And for contingent asset, right, we have to be virtually certain, which is higher than 95% probability. In that case, we have to review the correspondence from third party, maybe your lawyer, your insurance company, or insolvency practitioner, and then we're going to evaluate the probability and agreeing the figure into the disclosure note, right? And also we're going to review the correspondence from third party, confirming the amount awarded to the client, and agree the figure to other receivables and other income within the financial statement. Right? And we are also going to review post-year-end bank statements and cash book to confirm the amount received. Right? So there is a post-year-end bank statement because maybe eventually it has been settled. So you can compare the actual amount with your estimated amount. Right? Here's an example from March and June examination. So here the product has been contaminated. So the client got a lot of lawsuits from angry customer. So we're going to take substantive procedures on the legal claims. Right? So we review the correspondence. We review the correspondence with the lawyer and see the likely outcome. We discuss with the lawyer the likelihood and amount. We inspect the board minutes about the details, management's view of the likelihood, and we compare the levels of returns and claims to date. Right? Because the claims to date may reflect the pattern of the potential level of future claims. Right? If there are only a few customers suing you, then it sounds like okay. But if there is a lot of customers suing you right now, that means the potential level could be high. And we are going to obtain written representations from management that have been no other contaminations, incidents, and no other product liability claims, right? Because the contaminations can be a wider range, right? So we need the written representation, and then we're going to review the draft FS to understand the legal claims have been appropriately provided for or disclosed. Right? And accounting estimates, it is an inherently risky area, right? Because it's not based on fact. It's based on judgment and management judgment, right? And that means it's easily to be manipulated. So that is why when we are evaluating the accounting estimates, the professional skepticism is very important. So we make sure that the management's evaluation, the management's judgment should be reasonable without any bias. Right? So IAS 540 audit accounting estimates and related disclosure requires auditor to obtain an understanding necessary to allow the auditor to identify and assess the risk of MM. So first of all, we have to understand the environment of the regulatory factors, right? And including the requirement of the financial reporting framework, regulatory factors relating to accounting estimates, and the entity's internal controls related to accounting estimates, right? Whether they have the skills, and is there anyone review it, and what is the response to the results of the review, right? So with that background, we are more comfortable to test that accounting estimates, right? It should be the clients should have that environment and internal control for accounting estimates. And the auditor must separately assess inherent risk and control risk when assessing the risk of MM relating to accounting estimates. So when assessing inherent risk, the auditor should consider the degree to which the estimate is subject to estimation uncertainty, degree of complexity and subjectivity, and the degree of complexity, subjectivity used in the selection of management point estimate. Right. So if the accounting estimate is huge, and it's complex, and it's under the subjectivity, then we should then that means the inherent risk is high. Then we're going to look at the control risk. If the control is also weak, that means we have a pretty high detective risk, right? So that's accounting estimates. So auditors should also have a estimate, and we call it a range estimate. And of course, we can also have a point estimate, and we're gonna compare our estimate with the management's point estimates. If our estimate is far away from management's estimate, then that means we should take action to understand why the management's point estimate is so different with us, right? But if the management's point estimates is in the range of our estimates, we can have a range estimate from $10,000 to $50,000. It can be a range of estimate. We would agree if any number in between, right? So that is we should, as an auditor, we should have an estimation ourselves, right? And then we compare. So for share capital, reserves, and directors' remuneration, these are very straightforward. For capital, there should be an authorized share capital, a cash book for a cash receipt or amount not received, or inspect the board minutes. But for share capital, pay attention to those derivatives, convertible bonds, and if there's any incentives, there's any share payment or share incentives to employees, right? So that would be the risky area, but generally those are very straightforward. And for dividend, there should be a board minutes, and if dividend got paid, there should be a bank statement saying that a dividend has been paid, right? And inspect dividend warrants to grade dividend payment. And for dividend, we have different kind of dividend, right? It could be a common share, it could be a preference share. So just keep an eye on it. Right? And directors' emoluments, that is has to be disclosed on your annual financial statement. Right? So we obtain a cash and schedule of directors' remuneration split between wages, bonus, benefit, pension, contribution, and other remunerations. Right? Those has to be disclosed. And then we inspect the payroll records, and we inspect the bank statement to verify it has been paid, and we inspect the board minutes, and there should be a bonus announcements, right? And we obtain a written representation for directors that they have disclosed all remunerations. Right? And for reserves, we agree the opening reserves, and we agree movement in reserve to supporting document. Say if that's a revaluation goes to OCI, then we're gonna look into the OCI, combining the other audit procedures. Right? And for the P&L, those are the transactions and what we call an indirect audit. Right? So when we are auditing AR, and we're looking at receivable at the same time, and so for P&L, we will take normally we will take substantive analytical procedures like the trend of the ratios, the margins, the trend by different angles, by months, by department, by products. Right? You will find the pattern. And there are several items we are gonna talk about. And the first one is payroll. So for payroll, we cares about the completeness, accuracy, and occurrence. And the document, the evidence are from the control account, payment listing, pay slips, contracts, labor contracts, right? The hourly rate, timesheets, bank statement, starters and leavers form, which could be part of the master file, right? And payroll will be understated if it's not being paid, and payroll can be overstated if there is a fictitious employees. That means there's some fake names or person not or employees never worked in your company, right? And payroll will be misstated if errors are made. Right? People make mistake. So our procedure would be we agree the total wages and salary expense per the payroll control account to the general ledger, and we cast the monthly payroll listing. We recalculate the gross and net pay. We calculate the statutory deduction to confirm whether the correct deductions for this year have been included. We select a sample of joiners and leavers. We agree their date and their salary. And for salary, we agree the total net pay to the bank transfer listing. And for cash payment, we're gonna agree the cash withdrawal and equate to the week's wages paid, and agree the year-end tax liability to the payroll records, and subsequent payment to post-year-end cash book. And for a sample of individuals, agree the amount per the payroll listing to the personnel records. So that would be the standard procedures to payroll. So here's an example. The example is for the analytical procedures. So we have an average salary level for the past year, but this year we got a 5% merit increase and different months, and then we have an expectation on how much the overall salary and wages would be for this year, right? And then we compare our expectation to the amount on the book, and if the difference is very minimum, then we are basically okay with that. we can accept that. And for analytical procedures on payrolls, we're gonna perform a proof in total of total wages and salaries incorporating joiners and leavers, and any pay increase award, and we're gonna compare it, as we mentioned. And we compare the payroll figure for this year to last year to identify any unusual fluctuations, right? If in certain months the wages and salaries is obvious, it's significant jump higher or lower than the average, then we should look into that. Right? Another example is from the March and June examinations. So we were required to describe substantive procedures about the payroll expense. So as we mentioned, we're going to cast a sample, agreeing it, recalculate the gross and net. We're gonna, for a sample, we're gonna agree the total net pay to the bank transfer, approve total wages incorporating joiners and leavers, and we're gonna compare the total wages to prior year, which is an analytical procedures. We're gonna review monthly payroll charges, and compare with prior year budget, and we calculate overtime cost as a percentage of total wages, and we compare with prior year. So as you can see, there are many analytical procedures here, and we agree a sample of the individual wages per payroll and to personnel records and records of hours worked per the clock-in system. And we reperform the calculation of statutory deduction as the social insurance, the tax, right? And we select a sample of joiner and leavers and agreeing their start and leaving date to supporting documentations, and we're going to recalculate their salary. And we recalculate his holiday pay for a sample, and then we agree to holiday records. And then we select a sample of employee from HR records and agree salary per HR record to the payroll record, confirming the accuracy of the payroll expense. And we agree the payroll control account reconciliation to accounting records and investigate any difference. So that would be for the payroll. And then another important item on the P&L would be the revenue, right? Very important. And for revenue, we care about the completeness, cut off, occurrence, and accuracy. And for the source of evidence, it's from the revenue control account, sales daybook, sales invoice, and customer contracts, and GDN, sales order. So revenue will be understated if not average sales were recorded, and it will be overstated if fictitious sales happen. So our standard for revenue would be that we inspect a sample of GDNs before and after the year end, which is the cutoff, and we recalculate the discount and sales tax, and we elect a sample of customer orders and agree the order to GDNs and sales invoice. And we inspect credit notes after the year end and trace to GDN, right? And see whether we should reverse any sales in this year. And for revenue, analytical procedures can help a lot. With that, we can compare revenue against prior year and see why the revenue is fluctuating, and we compare the revenue with budget or forecast. We calculate the gross profit margin and compare it with the prior year. Right? And for purchase and other expense, our standard process would be we inspect the GRN before and after year end, which is also a cutoff, and we recalculate discounts and sales tax. We select sample of purchase order, agree to GRN, and also traced to the invoice. And we inspect the purchase invoice for a sample, and the purchase daybook for the amount, name of the client, and description of the goods. And with analytical procedures, we compare expense for each category on a year-on-year basis, and we look for the significant fluctuations. And we compare expenses against budget and investigate any fluctuations. And we calculate gross profit margin and compare with prior year to identify any possible misstatement of purchase, right? And we calculate operating profit margin and compare with prior year, right? So those are the audit procedures we're gonna carry out for purchase and other expense. And the very last for today, we will talk about the small entities and the non-for-profit entities. For small entities, they have a very simple activity, which is a good news for auditors because the risk could be lower, but the control is directly controlled by the owner, and which is also the manager, who is also the manager of the company. So that means it's so easily to be manipulated, and the system is simple, which is good news. But the bad news is that maybe there's no system, and the reliability is the person, is the accountant himself. So there is an advantage and disadvantage for small entities at the same time. So for evidence, we can follow the normal rules, the rules between risk and quantity of evidence. So if the risk is high, we take all substantive samples. We take everything. We look into everything, right? If the risk is high, and sometimes maybe if it's more efficient to carry out a full substantive audit. So we don't look into the control at all. We just take we just look into every document, right? There's no sampling. It's a full substantive audit, right? So the problems for small entities would be the management might override because it's the owner, also the manager at the same time, right? And there might be no segregation of duties. Maybe there is only 3 to 5 employees in that company, so there's no segregation, right? And less formal approaches. So considering the very limited manpower, there might be no approach, right? They could be very flexible. So that would be the problem for small entities. And there are other type of entities, which is the non-for-profit organizations, a church or other charities and public sectors, right? So their objective is not for profit. Their objective could be for service for the greater good, and they don't have any shareholder, they don't pay dividend. So, or the success of such a entity is they can provide the best service with the limited cost, which is the economic efficiency and effective of the service, which is the value for money, right? So their financial statement is different. It's not called a P&L, it's called a statement of financial activities. And the profit or loss goes to surplus or deficit. Right? And control risk could be high because there's no full-time employees in such an entity. Everyone could be a part-time, and there might not be segregation, right? And the use of volunteers, there's no guarantee that everyone is qualified, right? So as long as they are willing to donate their time and for free, right? So the use of they don't use any system, and so that brings a lot of risk to the audit, right? So for income, maybe because the income is from donations, and the donations may come from cash, check, all different kind of ways, and we're not issuing invoices. There's no GDNs, right? So it's not easy to trace to the revenue, and that means a greater risk of thief, right? So and with those donations, those donations can have a criteria or have a condition. So if eventually we're going to repay the donation, and we should not recognize the income, right? And maybe the fund is restricted because it might be used only for a particular purpose. So the funds could be restricted, and for those restricted fund, we should separately presenting them in the balance sheet, right? And for going concern, it's difficult to evaluate the going concern because it's donation based. So maybe this year there's a lot of donation, and next year there's no donation at all. It's difficult, right? And the complexity of regulations is high because there might be a lot of internal and external laws and regulations on those charity, on those non-for-profit entities, right? So when we are sending our audit team, we better send someone understand the related regulations of non-profit entities, right? Because they're different. Okay, for audit testing, we're still going to test the controls, the substantive procedures, and we're still going to follow the inquiries, expectations, and analytical procedures. So for the plannings, there is a difference because the risk is high for non-for-profit, as we mentioned, right? So we're going to define a low, comparatively lower materiality to reflect that risk, right? And we're going to send experienced staff to these kind of entities, to that engagement project. And for reporting, if sufficient evidence is not obtained, we're going to modify our audit opinion, right? And for other reporting responsibilities, maybe the scope of external audit for NFP is larger. For example, we're gonna looking into the financial statement, as well as the value for money, as well as the regularity, as well as the audit of performance in indicators. So that depends on your engagement. And here is an example. This is a non-for-profit, and it's they got two different kind of income. Income one is operating, so it's not operated by TPT themselves. It's operated by third party. So the third party going to send TPT a monthly reporting saying that here's the revenue, here's the cost, and this is your share of the profit, right? So this is income number one. Income number two is summer concerts. The concerts are gonna hold for 6 concerts each summer, and they're gonna selling the tickets, which is $40 each, and the capacity is 1,200 audience at one time, right? So this is the income. So the audit strategy would be an understatement of concert income because because it's decreased by 2.5%, right? And the overall statement of concert expense increased by 19.2%. So that is strange. So we're gonna that would be the audit risk identified. So there may be detection risk if adequate accounting records are not maintained for all income and expenditures, right? Especially because it's if the tickets is paid in cash, that means we might lose a lot of revenue, right? If there's no control, there's no monitor, right? That would be the risk, and the control implications should be in place. The controls should be in place. We are expecting controls like the pre-numbered tickets and return of unsold tickets, reconciling the tickets income and number of tickets, right? So in that way, we can lock the number of revenue, right? The number of tickets should match with the revenue, multiplying by multiple the unit cost of each ticket, right? And there are lots of the controls we're expecting. And our audit plan would be for the share of operating from a third party, we obtain breakdown and we agree monthly surplus. We use monthly report of the poor attendance and fees. We obtain direct confirmation from the third party. We agree up-to-date cash. And for the summer concert, we obtain ticket sales data. We compare income with prior year. We perform a reasonable test, and we agree the cost of beverage to purchase invoices. We calculate makeup on cost, and we compare cost by categories to prior year. We inspect invoices to confirm the fees paid to the banks. We agree amounts to paid to banks to the cash book and bank statement. Right? So for the poor operating cost, we obtain a breakdown of operating costs. We agree sample of cost to invoice, cash, and bank. We perform analytical procedures by comparing with prior year. And for non-current assets, we obtain the current non-current assets register and cash and agree. We trace the asset from register to physical, from physical to register, and we recalculate the depreciation, right? And for cash at bank, we obtain a bank confirmation letter, bank reconciliation, the reconcile items investigated. So those are the very typical procedures for a regular business-oriented company. So there's no change. And but for the revenue, for the income, you should pay a lot of attention and design specified procedures for the non-for-profit organization, because they have the different inherent risk, right? So and in addition to the financial statement audit, there might be a value for money audit. The VFM audit might identify that TFT could obtain a more cost-efficient service by using another provider or managed by themselves, right? So these are the non-for-profit organization. Just remember that they have a higher risk from the revenue, internal control, from the human resources, different perspective. They have that risk. Okay, so just take my advice. When you are sitting in the ACCA examinations for the answering the substantive procedures, you have to familiarize yourself with the regular procedures for each assertion and each account. So just try to remember the standard procedures, and when you're gonna need it in your exams, you can takes only 1 second to write down your correct answer. So this is the whole for today, and tomorrow will be the very last day for our lecture. We will talk about the completion and review and reporting. Thanks for watching for today.